Studios. The ausbiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB on this mammoth week of central bank action. I'm Juliette Sarli. It is a day where we have seen a little bit of a pullback, but of course it's been quite a good week, particularly when you look at the records that we've been continuing to see reached on global markets. The Fed, of course, very much in focus this week, and we saw quite a lot of powering happening in terms of US markets. Hopefully we'll get a read on our market in a moment, but I can tell you that the ASX 200 is down by 18 points or 0.25%, 7,763. All right, let's get to the three themes of the day then, because it really has been about what a drag, and that's the fact that energy stocks have been dragging on the overall local market today. The energy sector, certainly the underperformance when you look at the weakness over the day's trade, but actually the market is up 1.2%. This is the ASX 200 over the course of the week, which is a pretty good outcome. Today, though, the energy sector down by about 1.4%. I was just talking to Attila Wilnell about some of the effects on the oil price. There's so much going on. We know that we had those drone attacks on Russian refineries from Ukraine. We also had the move by the UN draft resolution calling for a ceasefire in Gaza. Feeling the squeeze, meanwhile, the RBA's Financial Stability Review released today, and they did indicate that they are seeing households and businesses being affected by, of course, this tighter monetary policy that we're seeing, and that was the core reason the board decided to leave rates on hold. Interestingly, though, they did also talk about the resilience of the overall economy and the fact that they think many mortgage holders could actually withstand another 50 basis points of hikes. Let's hope, at least from this mortgage holder, that doesn't happen. And ending on a high, as I mentioned, over the course of the week, it actually has been a really good one, very much dominated by central bank action. So we're up 1.2% over the course of the week on the ASX 200. Let's have a quick look at some of the sectors. I mentioned the weakness in oil stocks. I'm going to ask Ian to flip past that one because they're really small stocks. I want to look at some of the big movers today. Santos, Woodside Energy down by about 2%. Looking at the REITs as well, because of course they were very much in focus on this interest rate sensitive move. Goodman up by some 3.3%. Looking at the miners as well today, we've got the call from ANZ that perhaps iron ore has hit a floor, but certainly the iron ore miners were impacted today. Fortescue down by some 2.2%, $24.66. Not a lot of corporate news around, but Fisher & Paykel shares rallied by 7%, the company upgrading its earnings guidance for the financial year to be in the range of approximately 260 million Kiwi dollars to 265 million. The forecast up from their previous net profit after tax projection of a range of 250 to 260 million Kiwi dollars. Woodside Energy, though, fell along with Santos, so just really tracking this lower crude oil price. And of course, we were looking at the F1 focus on the call today, but we couldn't find a car-related theme for the stock of the day. So instead, we went with Fisher & Paykel Healthcare. Our call guest, Junbei Liu from Tribeca Investment Partners and Adam Dawes from Shaw & Partners gave us their take on the call.
It is a hold for me for this company. It is very expensive. There's other places, to be honest, in the healthcare space, much rather holding, Cochlear and the like. But stock itself is a hold. Look, I think the announcement is positive. So they upgraded earnings relative to expectations by between 2 and 4%, and share price up close to 6%. This was going to be the last bad result. Remember, this company was a huge beneficiary of COVID when they need all the ventilator, their machine, the product that goes into it, and then there was a huge the inventory glut pretty much in those hospital systems, in the emergencies around the world. So this company really struggled in the last 12 to 18 months, really cycling those really strong numbers, and it does seem that with this small upgrade, it does seem the worst is now past them.
And Fisher & Paykel, as well as Philips, have had product recalls as well, which has really hampered their share price, which has allowed ResMed to do quite well over that time also. So I'm with Jumbo. This is a hold from me as well. The only thing that I could see out of the result, obviously it looked fairly good, upgrade, which markets obviously like, but there was talk about some of their property valuations that they've got to come through to the market, and that mark to market, meaning that property valuations might be lower. So they've got some properties in Auckland and a couple around New Zealand. That is going to be told in their 31 March results, and that'll be reported on the 29th of May. So this one we need to be a little bit careful of, for some of those property valuations might temper that expectations as well as for that profits.
Let's get to our COB guest. Our Friday guest, Shane Oliver from AMP, joins us on what an extraordinary week. It must be economist Christmas when you get this many central bank decisions, Shane.
I don't know whether I'd describe it as Christmas. Christmas is usually a bit more relaxing than this week, because not only did we have all that those central banks, and there was an avalanche of them, we also had lots of economic data being released. And of course, today's FSR from the RBA. So a lot of stuff going on, but good week to get to the end of, I think.
Yeah, okay, well, let's start. I mean, there is so much to talk about, but let's start with the financial stability review that you mentioned, because Michelle Bullock in the media conference on Tuesday indicated that that was going to be key. I was kind of struck by the fact that they said they think that households or mortgage holders can withstand 50 more basis point hikes. I hope that's not happening, because at the same time, they also said that they're seeing the stretch, I guess, of the impact of the current rate setting.
That's right. I mean, the good thing about today's statement is that it's a lot shorter. Like the statement on monetary policy, Michelle Bullock has cut everything back down to make them more readable, which is good news. But they also left out some of the detail that was in the last financial stability review back in October, where they also indicated that something like 5% of households with a variable rate mortgage were so-called cash flow negative. But they also added that the measure of expenditure, essential expenditure, was very narrowly defined. And if you use a wider definition, you get about 13%. If you include those on fixed rate loans, that brings it even higher. So you're looking at a much higher number of households who are actually quite stretched. So yes, a cursory reading of the statement suggests a pretty benign interpretation. Most households hanging in there. I guess that means any percentage greater than 51% says most are hanging in there. But there is a sizable group, whether it's 5% or 13%, who are actually cash flow negative. And that's, if you do the numbers on that, particularly once you include those on fixed rates, you end up with something like 450,000 households, which is, 1.5 million people, which is quite a high number of households who are facing very difficult financial circumstances as a result of those high interest rates.
And when it comes to the overall market, I mean, I mentioned that over the week we are up, but as you mentioned as well, it's been a busy week, not only in terms of central banks, but data as well. You're seeing a bit of a Goldilocks scenario here, so not too hot, not too cold?
That's right. That seems to be the predominant theme. I think markets started to anticipate that from about October last year, when we had that mini correction into late October, and then markets took off. Hopes that, we'll avoid a hard landing, but we'll get inflation down. Some people call this immaculate disinflation, obviously stealing from the Bible and Christians on that front. But whether you believe it or not, so far the economic data is sort of consistent with it. Not entirely. The UK has been in a little recession. Japan was in there till it got revised away. Europe's virtually stalled. But if you look at global growth on average, it's still growing. Australian economy is still growing, and yet they've been able to get inflation down. So it does have an air of Goldilocks about it. And that's why financial markets, share markets in particular, are so happy, because even though we may not get the 7 rate cuts out of the US that markets had priced in earlier this year, investors are thinking, well, that's not so bad. Inflation's still coming down. Interest rates are still coming down, but we've got stronger growth. So it's a pretty good scenario. Question is can that continue? But I guess we've had predictions now for the last 2 years, people telling us there's going to be a recession around the corner, and that risk is still there. But whatever's happening here, the global economy and Australian economy just seems to keep plodding along.
Yeah, Goldilocks outstaying her welcome, perhaps, still sitting at all chairs in the Bears house. Let's have a look at some of the surprises, though, because, I mean, I guess the BOJ wasn't really a surprise, but you pointed out Taiwan hiking rates, and then, of course, we saw the Swiss bank coming out in front, too, with a rate cut.
That's right. There were a few surprises in there, and I missed out the incompetent central banks. I could have included Turkey, which hiked rates by 500 basis points. But I don't think they're credible to justify including here. Taiwan was certainly a surprise. I think their cash rate's only around 2% or so. They did cite higher inflation in there. So it does provide a warning that nothing is guaranteed here. They weren't expected to hike, but they did. Flip side, of course, is Switzerland, which surprisingly cut, citing lower inflation. But the overall thematic, I think, if you exclude the outliers, is and focus on the major central banks, is that central banks are returning to normal or preparing to start doing so. In the case of developed countries, central banks, where they're heading towards interest rate cuts. And Japan, of course, is the odd one out. It's coming from ultra easy monetary policy and going back towards more normal monetary policy. So they're where we were 2 years ago. Basically, and they're gradually doing that. But basic picture, I think, from central banks was a relatively optimistic one, particularly from the Fed, not quite saying Goldilocks, but almost there. The Bank of England, no more dissenting hawks on the Monetary Policy Committee. The Governor Bailey actually saying that things are going in the right direction for rate cuts. Obviously, the Swiss, Lagarde in Europe, referring to moving towards easing monetary conditions or taking away some of the tightening. So, and of course the RBA going back to neutral. So the overall picture is one of central banks still on track to cut interest rates this year, and that obviously helped share markets through the course of the week, in contrast to the sort of the messy picture you had, say, a week ago.
And Shane, a lot to look out for next week. I'm not going to say it's like New Year for economists if this week was Christmas, but we've got the PCE, we've got retail trade. Actually, that'll give us an indication as to whether or not Taylor Swift had any effect on the economy as well, perhaps.
That's precisely right. Next Thursday, we'll get some idea of that because the retail sales figures released in Australia. The numbers won't be in there completely because I don't think those retail sales will include the ticket sales, but it will include merchandise and money spent at venues and money on hotels and so on. So that will get in. It's just some of the other stuff on the tickets won't have made it in there. But yes, we also have the PCE. It's funny the way we all roll that term off our tongues. Everyone should understand it. But it does seem to be a term that more and more people have heard of. PCE, private final consumption deflator inflation in the US. So it's a bit different to the CPI. The CPI has weights which are changed every so often, I think once a year or so, whereas the PCE, the weights will change with spending. So every quarter or every month, I think the weights change in the US. So very different way of calculating it, but it's coming in lower than the CPI. The focus will be on the core PCE. Chair Jerome Powell indicated it might come in at 0.2%. I think the consensus is 0.3%, and that leaves the annual rate at 2.8%, which is still sort of going in the right direction. It's just the last couple of months have been a little bit higher than they were in the run-up to Christmas. But yeah, it will be another busy week economically, but at least we don't have all those central banks doing things, although there are some minor ones still having meetings next week, but the majors are out of the way.
All right. Well, have a great weekend. Enjoy your rest. I'm glad we could manage to get Taylor Swift in there. We're doing a great job trying to keep her relevant. Thanks so much, Shane. Have a
Thank you.
Have a great weekend. All right. Dr. Shane Oliver there from AMP. Let's have a quick look at the leaders and laggards. Fisher and Paykel we mentioned on the profit upgrade. Goodman Group doing well. Those REITs in focus. To the downside today, we saw weakness coming through in quite a few of the metals players, gold as well, Telix Pharmaceuticals off. And in the small end of town, the leaders today, the front runner, Australian Unity up by 12.5%. To the downside, who took the mantle for the biggest loser in the small caps? I know you're waiting, drum roll, Drum roll. There we go. Calidus Resources down 22%. Appen, that was one that a lot of people talked about today, actually, down 7.4%, 57 cents. All right, let's have a look at what is happening overnight. Retail sales from the UK, also Canada. Oh, do we get more talks from Powell? Yeah, he's actually going to be delivering opening remarks at a Fed Listens event in Washington, D.C. There you go, just rounding out a very busy central bank week. And having a look at the week ahead as well, we mentioned, of course, the retail sales, the Taylor Swift effect coming through. Consumer confidence will be out on Tuesday. CPI, a big one as well. And then when we have a look at perhaps what's happening globally next week as well, as Shane and I mentioned, the US PCE is a very big one. But let's have a look at where the market has finished the day's trade. We're down by about 1/3% over the day, really due to that energy effect, the laggard from those energy players. When I have a look at the sectors, REITs were the best performers, energy the worst, down 1.4%. But look, it's been a busy week and it's been a good week for markets as well. So strip out today's losses, we're still up 1.3% on the ASX 200 over the past 5 days and only 1% off the 52-week high. That does it for this week on ausbiz. It has been an incredibly busy week with all that central bank action. Of course, you can catch up on all of that and all our CEO interviews, our presenter series online, ausbiz.com.au. Have a fabulous weekend. We'll see you again on Monday.